Well, hey everybody. Thanks again for taking a little bit out of your day to sit down with us as we consider the source. I'm Michael Wagner, one of the co-founders here at Omnia Family Wealth, and I'm joined today by our very special guest, Alon Ozer, who is the Chief Investment Officer here at Omnia. Hey, Alon.
Hey, Michael.
So today I wanted to talk about portfolio construction, which I have a feeling you know a little bit about. And look, we've been hearing from a lot of different sources that it's getting more and more difficult to build portfolios these days. I think a lot of that is probably based on how people used to build portfolios, the classic two-asset portfolio where you have stocks and bonds and you're hoping that one goes up when the other one goes down. Really giving you a little background in terms of how portfolios have been constructed. And so, Alon, if you could comment, I guess, on that idea of a two-asset portfolio, and then contrast it with what we do here at Omnia.
Yeah, absolutely. So, correct. Historically, still going on today, portfolio would be constructed out of a couple of very specific buckets. It would be the main one's going to be equities, and then you're going to have the fixed income, and then you're going to have something that is called alternatives, which is not bonds or equity. So, and the reason for that was to diversify your portfolio, to have different sources of returns, and also not to have everything going up or down at the same time.
Sure.
So that's the idea. It doesn't always work, obviously, but now it's getting harder because one of the biggest portions of your portfolio, which is the fixed income, is basically not providing the returns that you need. Second, the whole idea of fixed income is when there is a crisis, the Fed lowers interest rates and then fixed income goes higher. It's kind of a element of protection in the portfolio, which doesn't really work in an interest rate such as this one environment. So the way that we look at portfolios is a little bit different. The sources of return are important, but we think that the sources of risk are much more important. So the way that we build portfolios is basically flipping the whole idea on its head. So we would look first at the risks, and based on that, we'll build the portfolio. When you build a portfolio, you have a couple of asset classes. Let's just take, for example, even real estate, somebody that a lot of investors like to invest in. So you would have a couple of different deals, and this one can generate 13%, this one can generate 15%, this one 11%, 12%. Overall, you have a lot of options, but the difference in the returns is not significant. What is significant at the end of the day, and usually these are investments that are closed for 5-7 years, is the risk that you're actually taking these investments. Because if the return is going to be more or less the same at the end of the day, what's important to focus on is on the risk. What is the probability of this manager not to provide the actual return, right? If something's going to happen, if the management team is not as strong as you think, or if the asset class has a problem, or there are different ways to look at the risk. But this is just an example. When you focus on the return and focus on another 1% here, another 1% there, it's not going to make a difference at the end of the day. What is going to make a difference is the underlying risk. So if you flip it, you actually have the ability to increase your returns, your compounding, and lowering your risk.
So it's interesting. So if I'm hearing you right, it's not so much that you target, let's say, for example, a portfolio that can generate a 7% return, right? What you are targeting is a portfolio with a risk characteristic of X, right? And that is really how you're building the portfolio, because that's what you feel like can be measured, controlled, and sort of analyzed and really used to build a strong portfolio.
Correct. That's correct. So we do take into consideration what is the return that we're going to achieve, because we want to fit it to the needs of the client. But if we focus on the risks first, we have the ability to generate this return with much better certainty than just looking at the returns and saying, okay, let's put A, B, C, D. The average is 7%. Great, let's go with that portfolio.
Sure.
Because as we all know, a lot of stuff we don't know, right? And a lot of things that happen in markets, and there's a lot of randomness. And And the best example is March of 2020, right?
Sure.
When everything went in the same direction, all the assets.
Right.
And this is extremely painful for the long-term compounding of your portfolio because you just lost 20-30% of your portfolio. That's a big drawdown.
No, and I think that's a really interesting example, right? Because we may have had an opinion, or people may have had an opinion, that markets were fairly priced late 2019, early 2020. But nobody really had a prediction or was out there saying that we're going to be facing a global pandemic and that's going to be the catalyst for this great market repricing.
No.
So it's really interesting, and as you said, that we don't know everything. We're not predictors of the future. These things can occur, and it's all about using a risk-centric view to build a portfolio that can weather the storm. We know something's going, there will be a storm, but we don't know when or how bad or where it's coming from, right?
Correct. That's exactly it. That's exactly it. And this is the best tool that we have. We know that things are going to happen. We know that the big numbers, the big drawdowns are the worst enemy of long-term compounding. But we can't predict them.
Could you dive a little deeper into that? Because we talk about risk, right? And you mentioned that in a specific investment, it may be that manager doesn't meet the desired return, right? But you just mentioned it as far as a portfolio for a person and a family, right? In terms of not meeting your personal goals.
Right.
That's a risk. So when you're building a portfolio, how do you think about all of these different, yes, there's risk overall, but then each investment has a risk, and then there's portfolio risk, and how do you look at that?
No, it's a very good question, and maybe I should have explained it before. So when we look at the investments themselves, of the actual allocations that we make, then we look at different types of of risks. So you're going to have the risk of not achieving the returns. You're going to have the risk of actually losing capital. You have the risk of liquidity. So you have different risks. So this is one level. But the ideal way to actually look at risk is at the overall level of the portfolio. This is something that is actually easier for us to control, because most of the major drawdowns happen when there's not one problem in a specific market, whether it's the real estate market or it's the equity market, or whether usually these are, like you said, storms where everything goes in the same direction because there is a major problem, either a pandemic, which we don't know when or how. It's nothing that you cannot, you can't predict it. Severe recession, a war, a geopolitical tension. It's something that you cannot predict. But what you can do is look at the overall portfolio, right? And look at the assets that you have, and which one of them can mitigate that risk and which one cannot. So, for example, I think that in our times, the best thing to look at is fixed income, because you lost the two main factors, right? The return and the risk mitigation in fixed income. So it would be much more efficient to take out a portion of that fixed income and put it in different strategies, right? Overall, we think that because we can predict, if we have the ability to take out the extreme events, not to worry about the extreme events, we can put so much more assets on the growth side, right? We can let the portfolio compound without the concern, because that's the reason that people have so much fixed income. They're afraid that they have their growth assets, and then they have their fixed income in case something happens, so they don't go bankrupt, right? But it's not ideal.
Right.
If there are other strategies that you can use where you use a much smaller portion of your portfolio, which are going to have a much better effect when you have these crises.
So, in other words, I think of it as a almost win by not losing strategy, where we think about compounding returns, and that's wonderful as long as those numbers are positive numbers and you're compounding positively. But a large negative drawdown can have a serious impact on the path of growth in your portfolio. So in order to avoid that unfortunate thing from happening, having a sharp drawdown, not to mention the investor psychology aspect of then people throwing their arms up and getting out of markets, maybe sitting in cash for the next few years, really building a portfolio that won't go down as much so that we're able to stay in the game, essentially, if I could boil it down into layman's terms. if you
Correct.
will.
Absolutely. Absolutely. If you focus on that problem, if you have, and it's something that we call the positive convexity in the portfolio, if you can have that, you can actually not only get out of the markets at the wrong time, it would help you psychologically,
Right.
right? You'll also be able to add more growth assets.
Right.
So the portfolio is going to grow much higher. We've been through a bull market for since 2009, basically,
yeah.
right? It's very difficult to say when it's going to stop, what's going to happen.
Right.
We had extreme events in the middle, right? We had the pandemic, but you still want to own more growth assets. Either
Right.
it's high yield, it's equities, it's whatever it is. You want to generate your returns, but you never do it because you're afraid that something is going to happen.
Right.
So if you're able to take that risk out, right? You never can take out everything, right?
Right.
That's not
No risk, no return.
Right. Not really possible. But if you can
Right.
take some of these extreme events outside of that equation, it's much easier for you to put to the growth assets and let them just run.
Right, right. Because it's always, I think another element of portfolio construction is that it's never set in stone. Right? We're constantly reviewing how we allocate to markets based
the
on
time.
what's going on in the world. So if we do have another repricing in markets, having the ability to nimbly make a change and reassess risks that are out there.
Correct. Correct. That's exactly the way.
I also have always found it fascinating how you can take what maybe a risky asset on its own, add it to a portfolio, and actually bring down the overall risk of that portfolio by adding what you might consider a risky asset, but since it plays in the sandbox differently than all the other assets, you can actually really smooth out your ride.
That's correct.
I don't know if you have anything to add to that. It's just something I've always thought was really cool about portfolio construction.
Yeah, that's one of the things that we do. So we talk about negative correlation between different assets. So yeah, if you have an asset that is negatively, the returns are negatively correlated to the other asset, then they can work good together. So the expected return is obviously positive. They just move in different directions, right?
So you want something
certain
zigging
times.
when everything else is zagging, but still kind of moving
Correct.
up and to the right.
Correct. So that's a great way to do it. The challenge with that is that again, when we have that storm, everything
Right.
goes in the same direction.
Right.
So that's why at the portfolio construction, you can have different assets that correlates differently between them. But at the portfolio level,
Sure.
you can have that convexity or that tail hedge that is small in your portfolio, but is just there in case something happens.
Almost like insurance, right? Where you pay a premium and you hope you never have to use it, but if something does happen, it can trigger a large payout.
That's correct. That's correct.
So
So,
looking-
the premium is rather low, but the benefit, right, when things happen, is very large.
Right.
And that's what you're looking to do.
Yeah.
I
So-
think it's simple, but it's something that can be done.
I know, and that's sort of the trick of a lot of this stuff is it's so complicated on one hand, and then boiling it down to, I think a lot of what we're talking about today is really focus on what you can control. Right? At the end of the day, you have no control over returns. You can control the level of aggregate risk in your portfolio, though.
Correct.
And if I were to think of, any sort of call to action or anything like that people can really think about is think about what kinds of risks do I have in my portfolio? What am I exposed to? What kind of risks am I not taking? That's my perspective on it. Alon, I'm curious if you have any thoughts in terms of if people are thinking about portfolio construction today, you have any advice or anything they should be thinking about?
Absolutely. It's not a new idea. It's not something that for us it's not new. Even legendary investor Benjamin Graham said that the essence of portfolio management is not focusing on the returns,
Right.
but focusing on you managing the risks basically. And I don't remember the exact words, but bottom line, that's what it is, right? So each return is associated with a different level of risk, right? But if you manage the risks, you'll have the returns. Like we said before, you have different assets. The projected returns are kind of the same, more or less the same, right? The risks are not.
Right.
But if you manage that risk, you have a much better probability of achieving these returns and higher, then you focus on the returns themselves.
So take a risk-minded approach to your portfolio. And as always, if you're struggling with this or you're thinking about it, reach out to a licensed financial advisor and have that conversation. As always, Alon, thank you for your time,
My pleasure.
your knowledge, just being here. Thank you.
Thank you.
And thank you, the viewer, for spending a few minutes today with me and Alon to sit down and consider the source.